In this video, I want to share with you a strange, little-known asset that has been used by the wealthy for decades. If you could use the same asset as the wealthy bankers, Fortune 500 CEOs, and celebrities have used to grow their wealth, would you? The reason the wealthy use these strategies is because of several powerful benefits. First, your money can grow when the market is up, but you never lose money due to market downturns. This growth is also tax-deferred, and it can create a lifetime of retirement cash flow. You can have low costs or even no costs when structured properly. And whenever I show this to somebody, the response is always the same. That seems too good to be true. Good growth, income for life, and protection from market crashes. However, there is some bad news. Even though these are proven assets backed by companies that are over 100 years old and are some of the strongest financial companies in the world, and they've been used by people like former NFL head coach Jim Harbaugh, business leaders like Conrad Hilton of Hilton Hotels and Walt Disney, JCPenney, and according to David McKnight, over 70% of the Fortune 500 companies use these for their executive compensation. However, many people still have a negative opinion of them because it's not what Wall Street promotes. I too was disappointed when I first heard it was an indexing strategy used by life and annuity companies. But then I dug a little deeper and found out how and why the wealthy use this quote-unquote boring strategy and how you could create a cash flow stream that lasts for life if you're open-minded enough to hang in there for just another minute. I say boring because buying insurance or annuities isn't exciting like investing in the next IPO or cryptocurrency. Of course, maybe you're not looking to gamble your life savings either. And that's exactly why this is so appealing, because it's designed to help you protect your life savings, grow your money, and create an income that could last for as long as you live. We use something called the indexing strategy, which allows you to grow your money during good years and never lose during market crashes. And what I discovered was that you can use these assets to create an income that is guaranteed for as long as you live, without worrying about losing your nest egg in a market downturn. Can your IRA or 401k do that? Of course not. What I discovered was that by using the index strategy, you can actually profit from the volatile world we live in instead of being hurt by it, and I'll show you how in just a second. Now, it's important that you understand why I'm sharing this. I've seen far too many people worried about the risk and uncertainty of their retirement. Market volatility, running out of money, and taxes are all concerns that many people have. So when I found something that has some great benefits, I wanted to share it with others. One of the main benefits of this strategy is that your money can grow when the market goes up, but you don't lose when the market goes down. It's called the indexing strategy because your growth in the policy is linked to an index like the S&P 500. When the index goes up, your money grows. But here's the kicker: when the index goes down, you don't lose. Your growth is locked in and protected each year. Here's an example of how this would work. The green line would be your indexing strategy that can grow up to a cap during the good years and then never go down when the market crashes. You can see that in the late 90s, the market was going gangbusters, 26 and 20%. But once the market crashed in the dot-com era, your green line stayed level. It did not lose value. So the green line shows the indexing strategy where you can get the ups without the downs. The red line is the actual performance of the market. And the blue line is what you would get if you invested in something that gave you conservative 5% growth year after year after year. And so you can see over time, when the market goes up and down, the volatile swings of the market, the indexing strategy that gives you growth during the good years up to a cap and then protection from down years outpaces the other two options significantly. Why is this? It's because losses make a significant impact in your growth. When you lose 50%, you have to get 100% return just to get back to even. And so those losses are extremely costly, and in many cases take years to recover. So using this strategy, you don't have to worry about losing your money in a stock market downturn. The second huge benefit is that when you decide, you can take an income stream that can last for the rest of your life. These assets have been designed to fill the gap created when American companies stopped offering lifetime pensions to their workers. Years ago, it was common to work for the same company and have a retirement income that they provided for the rest of your life. This is obviously no longer the case. 401ks have attempted to fill this gap. However, they're fraught with problems like market losses. They have no guaranteed income, and you can be paying a lot of taxes in retirement when you access your money. So this asset could give you peace of mind knowing that you have an income that will last as long as you do. Now, everybody knows diversification is a principle to reduce risk. So how much of your retirement do you have diversified into an asset that will never lose value and create a lifetime of retirement income? There are several different institutions and assets that take advantage of the indexing strategy. They can be offered by banks and insurance companies. The indexing strategy can be used in zero-fee hybrid annuities and index universal life policies. Some of these assets can actually give you tax-deferred growth and cash flow that comes to you in the 0% tax bracket. And so if protecting your nest egg from market crashes and creating a lifetime of retirement income sounds good to you, then the indexing strategy might be a valuable asset to add to your retirement plan. So if you'd like to see in black and white how much the index strategy could help add to your retirement cash flow, then you can request a blueprint on this page. On this blueprint, you will see exactly how much retirement cash flow you could add to your retirement. In some cases, it can be substantially higher than using traditional strategies like bank CDs, bonds, or even pulling 3 or 4% from your nest egg. We call this a blueprint so that we can actually run numbers specific to your personal situation and show you how much cash flow you could potentially have by using these different assets. There's no obligation to buy anything. You'll have a 15-minute appointment to see if this might be a good fit for your situation. Why are we giving away blueprints for free? Because we know that some people will see the benefits of using the indexing strategy and decide to have us help them implement it. However, if you don't, there's never any pressure and we'll part ways friends. So, request your blueprint appointment right now and let's get started.